Today I'm going to do a brief update where I feature a potential trade opportunity coming up this week, as I do each Saturday in our YouTube and Twitter videos. I'm Robert Miner with Dynamic Traders Group, and this is our weekly trading video where I teach you specific trade strategies on a current market position. And this week I'm going to feature the S&P and other stock indexes. It's a brief version of the more extensive analysis and educational videos that we provide our DT Report subscribers. Now, even if you don't trade the markets that we look at today, what you learn today you can apply to any market and any time frame, so pay attention. If you find the video useful, like us, subscribe so you'll be notified each time we upload a new video, and let your friends know all about it. Okay, let's get started. Let's take a look at the S&P. This is the S&P weekly data, and there's one key piece of information here that's valuable. And by the way, is you don't want to get analysis of paralysis. You don't want to have too many indicators, too many studies on your chart, all that sort of thing. You want to identify the one or two key pieces of information that's important and relevant. And the key piece of information that's important and relevant on the weekly data is the weekly momentum cycle is bullish and is not overbought. So it's in a position where typically there would be another 2 to 3 weeks of net bullish trend for the S&P. So it's not 100% every time, but nothing is in technical analysis or in trade strategies. But you'll look at what has the high probability outcome, and usually if the DT oscillator, at least the momentum indicator that I developed and I use, if it's bullish and not overbought, it means you got some time to go on the upside, another couple bars or so, depending on the time frame of data you're using. So that's very important piece of information. So that's what we see from the weekly data. And we'll take a look at what this label means when we take a look at the daily data, but that's the important piece of information. Here is the daily data. We always do multiple time frames. We always look at least 2 time frames of data, sometimes 3 or more. But the key is looking at the higher time frame for the probable trend direction and the lower time frame to trigger yourself and execute trades, trigger yourself into trades. So this is the daily data, and it's also close-only data. The weekly data was close-only data also. Close-only data really helps to eliminate some of the volatility, some of those news days that become very volatile. They make new highs and lows, but then they end up closing about where they were before the day began. So what I'm looking at is this decline off the January high into the March 8th low is impulsive in nature. It's probably in Elliott Wave terms a wave 1 or A, and that means it's not a complete correction. If it's a wave 1 or an A, we should have a wave 2 or a B corrective rally, and then we should have another section down to probably exceed this March low in a wave 3 or a wave C. So I'm not making a judgment whether the S&P is making an A and a B and a C or a 1 or 2 or 3. I want to look at either or, and in both cases it indicates that the S&P is making a correction that when it's complete, then it should have another swing down to a new low. So a correction is usually at least 3 sections. And in other words, it's usually at least an ABC. And it can be ABC zigzag, it can be ABC flat, irregular ABC. It can take all kinds of forms. But what's important from an Elliott Wave point of view is that an impulsive advance, and this is an impulsive advance, should not complete a correction. Just as this decline should not complete a correction, this rally should not complete the higher time frame wave 2 or B. So more than likely, it's right at the point of making what we call a wave A, right near the 62% retracement based on the closes. So there's some other time factors that indicate that this is near the end of this initial advance. Is going to make a daily high, and our DT oscillator, the momentum has already reversed the short-term momentum to bearish. Now that just means that the speed of the advance has declined. So that's why you can have a momentum indicator being bearish, but the price being bullish. It just means the rate of change is getting less and less. There's less buying power coming into the market. If we smooth this out with a little longer look back, we can see that as of Friday, this momentum made a dual look back bear reversal. That's where the fast line crossed below the slow line. And it's very significant because it's dual look back, and that means in this case the 13 made the bear reversal, and the next longer look back, the 21, was overbought at that time, either overbought or bearish in the overbought zone. That's a dual look back reversal. Very reliable when that reversal is made to indicate you're within a bar or two of completing a price cycle high. So that's what we're looking at in the days ahead. In the early next week, more than likely, and again, it's always probabilities, is more than likely the S&P will make what we call a daily high followed by a 3 to 5 day correction. And once that 3 to 5 day or so corrective decline, which will be a wave B, is complete, then it'll probably make another swing up to test or exceed whatever high it makes early next week, if it indeed does make that high early next week. So the real trade setup here, as far as I'm concerned, the best one, is, first of all, you do want to be aware that depending on your time frame, that the S&P is in a position to complete a daily high and be sideways to down 3 to 5 days. But what we really want to look at is to identify when the S&P is in a position to complete a corrective decline and then continue the weekly bull trend. Because if the major trend, the weekly trend, is bullish, we want to look for corrections and then continuation of that bullish trend. So one of the ways that we look at that is we look at the price retracement, we look at the time retracement, and then we look at our smaller time frame daily momentum cycle. And when the momentum cycle makes a bull reversal, frequently that coincides with the end of a corrective decline. So we're probably several days away from that, maybe even beyond this coming week, but we want to be aware of it. That'll be the dual time frame and multiple time frame momentum setup to complete a correction and continue a weekly bull trend. So that's what we're looking at in the days ahead. So if indeed this is a 1 or A decline, more than likely this corrective advance will be complete by around the middle of April. So that's as much as another 3 weeks away. That's exactly what the weekly momentum is indicating. Another 2 to 3 weeks sideways to up. So more than likely this corrective advance is not complete. Well, that's it for today. We'll keep alert to the stock indexes in the weeks to come. Thanks for checking us out. Check out our DT reports on dynamictraders.com.